Where will Apple stock be 2 years from now, and does the answer reveal something profound about the future of big tech investing? That question is sitting at the center of a bold new price prediction from the financial analysts at 24/7 Wall Street, and today we're going to break it down, layer by layer. Because this isn't just about a number on a screen, it's about understanding whether Apple remains the gold standard of wealth creation in the stock market, or whether its best days of explosive growth are quietly behind it. Let's start with the big picture. Apple is currently one of the most closely watched stocks on the planet. It sits comfortably in the $3 trillion market capitalization club, a figure that was almost unimaginable just a decade ago. But here's the uncomfortable truth that serious investors wrestle with: when a company gets that large, the mathematical challenge of sustaining growth becomes genuinely formidable. You simply cannot double a $3 trillion company the same way you doubled a $300 billion one. So when 24/7 Wall Street puts forward a 2-year price target for Apple, they're not just throwing darts at a board. Their analysis factors in Apple's forward price-to-earnings ratio, the trajectory of its services segment, hardware upgrade cycles, and critically, the emerging battlefield of artificial intelligence integration. And that last factor, AI, may be the single most important variable in this entire equation. Apple's rollout of Apple Intelligence, its branded suite of AI-powered features embedded across iPhone, iPad, and Mac, represents what many analysts believe is the company's next major upgrade supercycle catalyst. The theory goes like this: hundreds of millions of iPhone users are still carrying devices that are 3, 4, even 5 years old. When AI features become genuinely compelling and exclusive to newer hardware, those users upgrade. And when they upgrade, Apple doesn't just sell a phone, it deepens an ecosystem relationship that generates services revenue, subscription revenue, and accessory revenue for years afterward. That services flywheel is arguably the most underappreciated part of Apple's financial story. Services, which includes the App Store, Apple Music, iCloud, Apple TV Plus, and Apple Pay, now generates margins that dwarf the hardware business. As that segment continues growing as a percentage of total revenue, Apple's overall profit profile becomes richer, more predictable, and frankly, more attractive to institutional investors who prize stability. But the bear case deserves equal airtime, because intellectual honesty demands it. Apple faces genuine headwinds. Regulatory pressure in Europe and the United States threatens App Store economics. China, which represents a massive slice of iPhone revenue, remains geopolitically volatile. And Samsung, Google, and an increasingly capable Chinese smartphone industry are not standing still. Competition at every price point is intensifying, and Apple's premium pricing strategy only works as long as consumers believe the premium is justified. There's also the valuation question. Apple has historically traded at a premium multiple compared to other consumer electronics companies, justified by its brand loyalty and ecosystem stickiness. But if growth rates moderate even slightly, that premium multiple becomes harder to defend, and multiple compression can quietly erase gains even when the underlying business performs decently. What 24/7 Wall Street is essentially asking investors to weigh is this: does Apple's ecosystem durability, its AI integration roadmap, and its services expansion outweigh the very real ceiling that comes with being the world's most valuable company? The 2-year price target they've proposed reflects a measured optimism, not euphoria, but reasoned confidence grounded in Apple's track record of navigating transitions better than almost any company in corporate history. And perhaps that's the most thought-provoking takeaway of all: in a market obsessed with what's next, Apple keeps proving that what already exists, done extraordinarily well, can still be the most powerful investment thesis of them all.